Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to go over a trade setup for a directional breakout momentum type based trade on Amazon, but a way that you can do this trade structured using an option spread to give you very, very low risk, but a very high return based on the direction if you get that right. Now, we're currently in a really kind of, high uncertainty type market environment. We've got the FOMC meeting next week. We've got, a little bit of concern about the inflationary factors, CPI number tomorrow. But when we look at Amazon, the chart here, it's been in this consolidation phase for a full month, sitting right on top of this 200-day moving average. So you can see it's just been churning, and this is what we call volatility squeeze or compression squeeze. So it's created by sideways kind of churning cycle price action, and eventually this will either break out, of this tight range, either up or down, and we use momentum to give us probable direction. So what we call this called a momentum breakout potential trade. Now the problem with the trade is, it looks like a poised for a big pop to the upside, but there's a lot of, like I said, uncertainty in the market based on we've got a Fed meeting next week, will they taper, etc. So the way that we set this trade up is we did what we call a long call condor. So by doing this, we can really get our risk very controlled, very, very defined and low. It'll give us a positive theta in case it keeps churning sideways, and we can easily adjust it to reduce the risk down to zero or credit. So here's the long call condor and how it looks and how it works. So this was the trade setup today. I've got alert service that sends these types of trades out to our members. But what we did was this long call condor. So we went long as a spread. You can leg into it as well. We went long next week, the 18 June, 335 call, short the 3340. And then we did another short call credit spread on top of that, the 3380, 3385. So max risk is $60 debit paid. So $60 is your maximum you could lose on the trade. Now, next week, Friday the 18th, if it was to go out between the two short strikes of the two spreads, this would make $440, and $440 on your risk of 60, that would be a 733% return. But I always like to look at risk first. Now, the other thing we could do if we start getting some really negative data points on inflation, etc., we can make this into what we call a broken wing call condor. So we could do something like we could come out and sell another bear call credit spread. We could sell like another of the 18 June 3380, 3385, and that went out today on the close at $82 credit. So if we added that to it, now we have zero risk to the downside. We've actually got a $22 credit. All right, so we have zero risk to the downside, and next week going into Friday expiration, if it closes positive, between the short strikes here, we have $522, and we've also increased our positive theta. So it's a really great trade setup for controlling risk in uncertain market conditions, and also controlling and giving you a positive theta in case it keeps churning sideways. So I hope this helps. If you'd like to learn more about these types of trade and directional trade setups, make sure to join us at PowerCycleTrading.com. Good luck trading.